think we're probably in a good spot to get started. Thanks all for coming to a very quick lunch and learn hosted by Alpha Theory and Omega Point. This was something that was topical. I had a conversation with the CEO of Omega Point, Omer, last week, and he was talking about some of the work that they were doing and as it related to their clients and their desire to understand the risks in their portfolio as it related to the Russian invasion of Ukraine. And I thought that that was extremely interesting and something that our clients would find useful. So we're lucky enough to have Omer come and speak with us today and give us his thoughts on how his clients are managing this new risk and how they're measuring it in their portfolio. And we'll show you how the integration with Omega Point can highlight those risks in your portfolio today so that we can tie together both what Alpha Theory is saying and what these new risks are saying and make adaptations to the portfolio. So with that, I will turn it over to Omer. We'll go through, Omer will do a quick overview of the things that they've learned. We'll show it in the application for both Omega Point and Alpha Theory, and then turn it over for questions because I'm sure you guys have some. So with that, I'll turn it over to Omer.
Fantastic. Thank you, Cameron. And everyone, really appreciate you taking the time. I know this is, the markets are very turbulent. There's a lot going on, and every half hour or 45 minutes you have to spare is probably being taken up. So the fact that you chose to be here with us today is greatly appreciated. As Cameron said, I think perhaps might be worth sort of giving a little bit of a background for those of you who don't know about Omega Point. You know, we are sort of a quant enabled or sort of a risk management system that's used to help bring sort of a lot of the quant related data, factors, other data sets, make them easy to use for particularly fundamental managers. And you know, we work with a lot of different sort of managers that really have a need to understand their risk in their portfolios from this point of view. And in times like this, where there's a very large geopolitical event that is driving the markets in many different particular directions, and it's not clear that it's just a risk on, risk off period, like we saw maybe during the pandemic or 2008. It seems like there's definitely a lot happening here, nuanced and variables. This is really where some of the information coming out of the quant sort of factor world can help provide guidance as to what's happening here. And this is really has to do in this particular case with the fact that, you know, we're not going again to a pure, yet at least into a pure sort of an economic recession. We're realigning. There's a realignment in the world economy right now. We're essentially the 11th largest economy is being isolated, and investors are realizing that there's going to be sort of either increases in, as we know, some commodity prices, but also there's going to be different players out there potentially filling gaps for the supply shortages that are coming from that economy. And so the question really is, and this is why we're calling it sort of this new world economic order, you know, there's a key question here, right? Well, how am I exposed to this new world economic order? I can definitely do a bottoms up analysis on every company that's, you know, has exposure to a particular, you know, to oil and gas coming out of Russia. There's a lot of work that can be done on the fundamental basis. So I appreciate that many of you are probably doing that. But one of the things that we recognize is that these sort of quantitative factors can help us maybe find a different lens on the problem. So with that said, you know, in jumping in, I wanted to kind of point out one critical problem, though, with this sort of notion that some of the kind of obvious questions that investors asking, sort of what is my risk to this new world economic order? Is my risk to Russia? To try to do any kind of analysis, you're going to be probably finding that it's very hard to link the past, which is what we're seeing here. On Feb 23rd, I think, you know, Russia had essentially a 0.9 beta to the world index, right? Meaning if the world would have moved up, global market like an acne, right, would have moved up by 1%, then the expectation is that Russia would have moved 0.9% over that period of time. But we recognize that that didn't obviously happen. And the decoupling created such a massive move that is different and is unaccounted for by the historical correlations of Russia with the markets, so that it's really not possible to use any sort of Russian assets, even presumably now, obviously with markets being closed there, in making any assessment about these exposures. So that's just a kind of a minor point. I think it's probably understood that you can't use it, but then the question obviously is, well, if you can't use Russia and you can't really look at it using any kind of Russian assets, what is it that you can actually use? And so this is really where the component that we wanted to go into and really talk to you about today is this concept of, well, if we can't use Russia at all, we can maybe look at the market reaction, right, across stocks outside of Russia through the lens of these sort of quantitative factors, and quantify what we call a surprise, right? So it was clearly a surprise. The invasion, while there was obviously intelligence that it could happen, it was clearly a surprise to the market on Feb 24th and beyond. And so investors repositioning themselves based on this surprise created flows in particular areas that are quantified. And those flows, right, as defined by the factor moves from February 24th through now, divided by what the expected factor move would have been, right? So on Feb 23rd, the assumption is that the factor would have moved in a particular direction. You think about it sort of a volatility perspective. This ratio that you see here is sort of a intuitive ratio to quantify what we call surprise, right? Because it was, again, new information that came into the marketplace. And we recognize that there's probably differential knowledge on factors here. There's probably some people that have spent a lot of time with factors, people who have spent less time with factors. We do have, after the presentation, we can definitely do, if any Q&A comes in about defining factors, we have some slides on those as well. And we're happy to send the presentation out after the call with some sort of primer on factors as well, to help people kind of understand how these factors are being defined from that perspective. But for the purposes of the keeping the call sort of punchy and really kind of hitting the key points, I mean, we'll assume that people kind of understand, generally speaking, what a factor is. So leveraging this concept of surprise, really want to dive in and talk about the various types of surprises that we saw. And there's really kind of three types of factors that you can think of that we're watching here. There's what people call macro factors. So you can understand oil and gas obviously being a macro factor. There are factors called style factors, and that's sort of factors that you may have heard of, like size, volatility, profitability, various factors that might align with fundamentals or might align with some sort of technical moves in the marketplace. And then there's industry factors, which most people just define as oftentimes just as GICS industries, but we can explain they're a little bit different, but they're essentially representing the movements of industries in the market. So what we're seeing here are the style and macro factors that have the biggest positive surprises since February 24th. And no surprise, pun intended there, that we see oil being actually commodities, non-oil and oil commodities. We know that there's obviously a large oil component here in this realignment. There's also a large component around wheat, for instance, that there's a shortage in supply. We also know that there's a component around nickel that we've seen. So inherently, it makes sense why a macro factor, that is tied to commodities would be showing the largest sort of surprise metric, again, in standard deviation moves. The non-oil commodities actually outperform the oil ones, are up 3.4 standard deviations. Oil's 2 standard deviations. As you guys can imagine, when you think about standard deviations, a 2 standard deviation move assumes that there's only a 5% chance that you're going to see it on any given regular day. So naturally, if you're at north of a 3 standard deviation move, there's even less than a 1% chance that you'll see it. So naturally, these are not normal times, and that's why we're seeing these very large standard deviation moves. The other ones that are interesting are also exchange rate sensitivity, which are linked also to sort of the concept of commodities and exporters, but you think of exchange rate sensitivity as basically a factor that measures the sensitivities of a company's, essentially think about revenues to global currencies outside of the US. So it's kind of the concept of like net exporter versus net importer, right? If you are exporting and a lot of your revenues are in currencies, people are paying in currencies outside of US currency, you'll have more sensitivity and fluctuations to currencies outside of that. If you're a net importer, you're obviously, you're selling in the US and you're seeing most of your currency in the local currency. And so we're seeing also that net exporters are seeing a bump in their surprise. So that's natural. Profitability, which is a fundamental factor. It's essentially a factor that you think about measures, the cash flows of a company, sort of how, I think it's sort of a return on, think of it as like an ROE, ROI type of a metric. But the concept is that more profitable companies that have strong balance sheets and are showing strong cash flows in a market environment like this are going to be probably more desirable to be in over this period of time. And we're seeing that as well. And then finally, and this is really a fairly recent one, I think we saw this in just the last three to 4 days, and is really around the short interest or crowding factors are starting to inflect. And you'll see this in the next slide on the long side. But the short interest is heavy, are basically crowded shorts are rallying, right? It means crowded shorts are going up right now. And that has to do probably with some of the hedge fund deleveraging that is going on. And so, we talked about positive, now we're moving to negative on the style side. Here, again, pointing out the hedge fund crowding on the long side is basically the long leg, the short interest is the short leg. So you're actually seeing a simultaneous drop in hedge fund crowding, and an increase in short interest, which makes sense. That there's the deleveraging is happening on both sides of the balance of the equation, on the long and on the short side. We've seen also dividend yield and value stocks, really kind of there be a move to value, likely due to interest rates. The fact that interest rates are not going to be potentially going up or rising at the level that people expect, that is likely going to be impact on value, which is tends to be tied to interest rates. And finally, I think I don't want to sort of ignore this one, but this is an interesting one, and it's tied to oil and gas in the short term. There's, as many of you know, there's a carbon market, primarily, traded in Europe, and the carbon market essentially has seen a massive crash in the price of these carbon emissions. Again, likely linked to the fact that in the short term, Europe, if they don't have access to gas and oil, they're going to potentially waive emissions restrictions to be able to give access to any kind of source of energy that is going to be able to provide them with energy over the short period of time. So that's those are the big surprises on the sort of style and macro side. We're going to move to the sectors for a couple of minutes, but I think maybe those are a little bit more intuitive sometimes to the fundamental managers. They kind of look at it and they say, all right, well, this is more aligned around sort of understanding kind of the fundamentals of what's happening here. You can see, won't go through all of them, but naturally aerospace and defense, developed ex-US, emerging markets, global. I mean, basically all aerospace and defense has been seeing massive rallies. And this is a 7.6 standard deviation moves in the aerospace and defense sector. It's not a sector that moves dramatically a lot. It's a fairly low volatile sector on any given day, and people don't expect much from it. Obviously, in a time like this, you would imagine why aerospace and defense are seeing moves that would be considered once in, I don't know, certainly 1,000 years, but it's really more a function of, obviously we know tails tend to be fatter in these instances than what the models would predict them to be. Naturally, we see metals and mining, we see energy as expected, we see safety around telecom, media, obviously probably linked to the fact of the news aspect, and then utilities, right? So a lot of this is probably no surprise to people that are looking at this, aligned with the types of sanctions-oriented, safety-oriented, and obviously defense-oriented themes that are coming in from this crisis. And then to cap it off on the negative side, we're seeing essentially in some ways it's sort of, as we know, the supply chain effect. The raw materials producers are going to benefit, but the folks who have to buy raw materials to distribute them into the consumer, and possibly because consumer prices won't go up. It's not like you can sell an auto for 20 or 30% more just because your components are going up, are likely to impact the providers out there. Wheat is obviously, as we said, a big problem around the food and beverages. Financials is an obvious one because we know likely rates are not going to be going down. Airlines around travel and so on and so forth. One area that's interesting is you can see U.S. This is just so you know, this is U.S. utilities that are seeing a dramatic move down in their surprises, and that has likely to do with the fact that the less regulated nature of the U.S. market, in the fact that if your input prices are going to go up, but your rate base is going to stay the same as you're selling to consumers, you're not going to be able to raise the kilowatt hour prices, but you'll still have to pay more to do that to be able to generate the electricity. Then it's likely going to see a negative impact on these producers. So I think I know went through a lot of material in a short period of time. Again, the point is to kind of give you a lot of this information, but also say, hey, you know what? This is not something that you have to sort of record, write it down feverishly, go to a lot of different systems to look at. This information is actually available to you on Alpha Theory. And I'm going to hand it over to Cameron to really talk about how you can use the data in Alpha Theory to be able to do this. And in particular, I think we're going to talk about some of the style factors as an example. I think in particular around, exchange rate sensitivity, around profitability in particular, because it's a very well-known sort of a fundamental factor that you probably have a lot of intuition for, in dividend yield, and how those are sort of positioned in one of the portfolios that Alpha Theory has on their system. So Cameron, I'm going to hand it over to you.
Yeah, great. Thanks, Omer. I think that once you see the surprises, the natural question is, how am I exposed to those? And so I just selected a few things, and for a few things, seeing this in an Alpha Theory view, this is a demo account. You see exchange rate sensitivity, profitability, and dividend yield, and it's showing you by security, both long and short, and it's a summation of that at the bottom to tell you total exposure. You can see exchange rate sensitivity. I don't have a ton of exposure, even though it's a big positive surpriser. I don't have a ton of exposure. I'm 6% exposed. Profitability and dividend yield, though, I do have quite a bit of exposure. Profitability is something that is a big positive surpriser, and I'm pretty short it. And dividend yield is a negative surpriser, and I am also short it. So maybe out of these things, since I don't have a ton of exchange rate exposure, I'm fine there. And the dividend yield, because it's a negative surpriser and I'm short it, maybe I'm okay with that. But maybe this profitability, since it's a positive surpriser and I'm short it, maybe that's something I want to neutralize. And so how would I neutralize this exposure? If we flip to the next slide, the way that I would do that is I would want to find the securities in my portfolio where my research, the optimal position size, was suggesting that I make a trade, and it also increased our profitability exposure. And so in this example, we can see that if I make my PSTG trade, my Tesla trade, and my Microsoft trade, which is to trim 9% of PSTG, trim 5.7% of Tesla, and add to Microsoft, I would increase my profitability exposure by 5.6, 1.4, and 1.1, and really get me where I was negative 22% before to something closer to negative 12%. And this is a nice combination of where there may be risk exposures in the portfolio and research exposures in the portfolio, and you can kill two birds with one stone. So it's exciting. This is a new relationship that we have at Omega Point, being able to pull this data in, and it's nice to be able to show you in something that has time that is timely.
Fantastic. Thank you, Cameron. I think that, reiterate, very excited about this. It's really important to be able to understand where your research aligns with all these sort of risk factors. And that's one of the key feedback points, right? I think that we've gotten over the years is that we really need to align those two. I want to align my alpha research and I want to align my the risks, and I want to be able to see it in really one place in an easy to use fashion. So I think that that's hopefully kind of helps solve that problem. And again, access to all these different factors is available on Alpha Theory directly. So you can see that immediately. One additional point on Omega Point, if you do have, for instance, different trades or new trades, or you want to test new names and kind of there's, want to go through more of a broader portfolio realignment and construction process, you can do that as well there. Again, the way that we work with Alpha Theory is if you already have an account through Alpha Theory and you're able to see all these exposures, then you should be able to see the same thing on Omega Point and be able to log in and do that as well. So just wanted to highlight that's possible too. In this particular example, not that we sort of aligned it with profitability, we also have access to some other things like oil beta and other factors that might be, timely from a kind of a macro perspective.
So maybe with that, what we can do is open it up to a few questions. I think we already have a question that came across. So Omer, this is definitely something for you, not me. It asks, does this analysis assume that the February 24th surprise correlation will hold or be repeated? And what if the next Russia-Ukraine surprise mix is fluid? So I'll let you answer that, but just for what it's worth, everyone that's on the call, you can ask questions down below and we'll be able to answer them like this.
Fantastic. That's a phenomenally good question. And the short answer is yes. The expectation is that there's going to be sort of an alignment around some of these factor exposures, right, are going to continue to potentially be the favorites, and the ones that are going to be less favorite are going to stay in that sort of realm. And obviously every day, just so you're aware, Omega Point every day is measuring the cumulative surprise. So we're watching which factors come in and out of the equation, which ones are sort of on the borderline. So we have pretty much, access to all the different factors. And so you can see, even if it's not a 3 standard deviation mover yet, but it's at, 2.5 or it's at 1.5, it might still be interesting. But as you said, it's a very dynamic situation. And the expectation is that things are, the geopolitical nature of this whole crisis is that you don't know what the next day will bring. There may be negotiations, there may not be negotiations. We know that it's very fluid. So the natural kind of question is, can I maintain an understanding of what these surprise factors are on a cumulative basis, right, and on a trend basis over this period of the crisis? And that's exactly kind of what we're doing for our customers, and obviously happy to do for the Alpha Theory customers as well. But keeping a tab of which coming in and changing.
So another question, Omer, you have had lots of conversations with folks that are trying to deal with this and how it impacts their portfolio. What are the big surprises that you're seeing from these conversations? And is it factors they wouldn't have expected to move in the way that they moved, or any other surprises?
Yeah, I think that the biggest sort of, not saying aha, but realization by looking at this is that this is not a risk on, risk off, a classic risk on, risk off scenario, right? Like what we saw during the pandemic.
Maybe take a second to describe what a risk on, risk off is.
Mm-hmm. So risk on, risk off is basically the concept of, okay, you know what? The world is going to hell in a handbasket, and everything is sort of, where we're contracting the economy. Maybe there's a financial crisis, right? Think about 2008. Think about the pandemic of 2020. Risky assets, any asset that has a concept of a lot of risk with it, right? So high volatility, high beta. It may be sensitive to a lot of different sort of kind of risky factors. I mean, commodities are actually highly risky, right? Typically during a recessionary environment. And what you typically see in these types of instances is that people are selling off the risky the risky factors and the risky asset, then they're going to safety, right? They're buying any kind of safe stock that they can find. Big caps, profitable, likely on healthcare, telcos, tech, and they're pushing all their sort of bets into that. And it creates this big divergence in the marketplace between what people call sort of risky and non-risky or less risky assets. In this type of an environment, and in particular, because of the commodity shortages in supply, you're seeing actually a lot of the risky assets that normally would be sold off. I mean, think about during the pandemic of 2020, oil was sold off. I mean, we went negative, right, for a period of time. It's the exact opposite. And because of that, people are talking about this environment as not being so much of a risk-on, risk-off environment, but more of a realignment, an economic realignment environment. So it's sort of the concept of like, well, okay, if we're realigning kind of the world economy, who's going to benefit, who's not going to benefit? And there's a lot more nuances that you have to explore, because those nuances are going to be at the industry level, they're going to be at the region level. And, and they're certainly going to favor certain types of characteristics over others as this crisis unfolds.
Great. Well, look at us. We actually kept it to our 30-minute time frame, which is something we're not known for doing. But Omer, I want to thank you a ton for coming on. I appreciate you being willing to take your time and spend a few minutes with the Alpha Theory network here. And if you guys have any further questions, you know how to get in touch with us. And thanks all for making the time to eat lunch with us today.
Fantastic. Thank you, everyone. Really appreciate it. And definitely reach out.